Elsa, let's start here. Do you think we might be in the foothills of a currency war?
I wouldn't term it a currency war because what banks are trying to achieve, what central banks are trying to achieve is very different. Here, actually, currency strength can be a good thing in that it helps you target imported inflation, whereas typically we think of currency wars as trying to artificially weaken your currency.
That's what I'm trying to get at, Elsa. Is it the last decade in reverse? Is this a very, very different kind of currency war compared to what we've seen in the past? A currency war, nevertheless, but with a different objective, and not everyone can win.
Well, I guess the difference here is that we're not going to see active intervention with one or two possible exceptions. I mean, we've talked a little bit about the Bank of Japan, but we're not going to see active intervention in order to generate a stronger currency. But we will see is central banks taking into account the impact of policy on the currency and how they can generate that lower imported inflation. So I guess I wouldn't call it a currency war because the currency isn't going to be the main tool. But certainly, I think where you're absolutely right, central banks are going to be far more comfortable looking for a stronger currency against their peers.
Elsa, to borrow from the wonderful William Rhodes, is this coordinated? Is Powell central banker to the world, or is the bond market central banker to the world?
Well, at the moment, it feels like global inflationary pressures have the upper hand, right? And that's, I think, what we heard yesterday. In traditional times, central bankers would focus on core inflation because that's the best predictor for future inflation. And yet, at the moment, with headline so high relative to historic periods, we're actually seeing that feed through into inflation expectations. And that's really what has central bankers worried.
Right now, we're also looking at a race to tighten rates the quickest in order to deal with the inflationary input. How much do you think, perhaps to John's point, we're not necessarily going to get a currency war, but we will get pressure from central banks and other central banks to raise rates simply to keep pace, to not increase the inflationary pressures in their economy?
Yeah, and I think that's what we saw this morning with the S&B. I mean, that's really notable. As you said, first time in 15 years they're raising rates. And this is a central bank which up until very recently was actively intervening, trying to weaken their currency, really targeting a much weaker currency over a very long period of time. And here we have the central bank just stepping away and not just hiking rates, but surprising markets with a larger than expected hike. That's a very clear signal of intent. And like you say, it does create some pressure whether or not others will choose to follow.
Elsa, what do you expect the ECB will do in response to this, given the fact that you are seeing that tightening from even the Swiss National Bank? Are they going to come out and surprise to the upside? And will that be positive or negative for the euro?
They're in a really difficult spot, right? And here is where you see the impact of making monetary policy for such a disparate group of economies really coming to the fore. Because yes, on the one hand, they'd like to go faster. They do have the same inflationary problems a lot of people do. If anything, commodity prices are much higher in Europe than they are elsewhere in the world. But then at the same time, as rates go up, that's causing a lot of pressure on the periphery. And so yes, we heard that kind of extraordinary meeting yesterday. They promised to come up with some new tool, no details as yet. I do think that the fact that they're considering fragmentation will actually keep them near the back of the queue in terms of hiking rates. And so I've got to say, from a cyclical perspective, I'd be a little bit more negative on the euro.